Okay, good afternoon, everybody. Today is Thursday, September 21st. This will be your weekly take on the market. Today is Thursday. The market is closed, but I need to do the video today rather than tomorrow due to some other obligations. I feel like the last few days in the market make it okay to do the video today, as there have been two significant days on the with the Fed meeting and today's action here on Thursday. So once again, I'll be your host. My name is Scott St. Clair, the manager of the Premium Product Group here at Investors Business Daily. Please take a moment for the disclaimer. I'm not licensed. I don't give buy, sell, hold ideas. Can't tell you what to buy, when to buy, how many stocks to buy. Okay, great. Thank you. All right, so typical. We've got like a three-legged stool here, market thoughts, uh, some things that I found during the week, whether it's on Twitter or Substack or things I read. I read a lot of stuff, skim a lot of stuff, honestly, really looking for headlines that kind of jump out at me to make podcasts, things like that. And then we'll do stocks to watch. Then we'll talk about the industry groups briefly. A lot of times there's not a whole lot there. It just depends on the market. And then my usual quote of the week. So this just came across my Twitter feed a few hours ago. I thought it was interesting. The trading volume on the top three companies, NASDAQ overlaid versus the New York Stock Exchange. Typically, I guess it can change, but I guess typically right now, as we sit here, NVIDIA, Tesla, and Apple these are the top three companies. And you can see the huge spike versus like even 2000 or 2012. But there's just a lot of interest in the NASDAQ. It's been the only game in town for a long, long time. It doesn't mean it has to change, but markets are cyclical. They go in over long periods. They come and go. Things fall out of favor. Things come back in favor. And big cap technology has been in favor for a long, long time. And so you have to kind of think about that. I know a lot of people like to use the baseball analogy. What inning are we in? And it's very, very difficult to know. But sometimes I think, well, it's it's not the first inning or it's not the ninth inning. You maybe you can guesstimate second or third inning or seventh or eighth inning. That usually you have a better chance there. The first and ninth is probably much harder. So there's just a lot of interest in this area. It's been and rightfully so, the best companies: NVIDIA, Tesla, Apple, Microsoft, Meta. What else? Fall Google. All the best companies pretty much in the world fall in this category. But if you've ever seen a chart of, the biggest companies in 1980, the biggest companies in 1990, the biggest companies in 2000, the biggest companies in 2010, one thing you'll find is almost always that list is different. And I'm not saying slightly different, I mean different. IBM, AT&T, et cetera, in 1980, Microsoft, et cetera, Cisco in 2000, Exxon, and who else would have been there in 2010, and so on and so forth. So you have to be open to change, that be flexible to what the message that the market is telling you. This chart kind of goes hand in hand on U.S. tech stocks. They both play off each other, and the U.S. is just beating the pants off of global. And the problem with charts like this, I'll be the first to admit, is like if you thought that it was extreme, in 2018, it got more extreme in 2020, and then it got more extreme in 2023, which is really what can happen. So you have to be careful on like trying to go against something like this. But if you're going with it, you probably want to be aware of where you sit in the greater scheme of things. I thought this is really interesting. Probably not a Ron Barrett's favorite picture. Not a very flattering picture of the guy, but boy, what an investor he is. So he has that going for him for sure. of the thousands of mutual funds, he's got the only mutual fund that's beaten the NASDAQ 100 over the last 5, 10, and 15 years. And how has he done that? I haven't dug in exactly, but I know one way that's truly helped him is he's been a long-term bull on Tesla, and he's held it the whole way. And I don't know what percentage it is, but as it's gone up, it becomes a greater and greater percentage of your portfolio. And if he hasn't trimmed any, so he's done really, really well with Tesla. But it just goes to show how hard it is for these mutual funds to beat these averages. And this is the NASDAQ 100, not the NASDAQ, not the S&P. There are probably a lot more that have done that, but it's still very difficult for these large funds to beat these indexes, which is the one advantage that we have as smaller investors, is the ability to move around and be concentrated and be 60% invested if the market environment isn't that great, or if you use margin, be 130% invested if the market environment is really good. All right, before we jump into the industry groups, let's go ahead and pull up the indexes. So here is a chart of the NASDAQ, and let's revisit this again. I know I've talked about this a few times, but it's important to understand as you start to think about markets. It's turned out to be a really good signal. It's my favorite signal for market tops and market bottoms is divergences. So the NASDAQ makes a high here on 719. You're in this really good uptrend. So on 719, the NASDAQ makes a high, and the S&P on 719 makes this high here, right there. Okay. Fast forward to 727, the S&P actually makes a higher high. It's kind of a weird day. I don't know if there was a news event related today, like, one of the 3-letter economic indicators, but 4607, maybe it opened there and then it proceeded to close pretty poorly. And so that date is 727. You make a higher high in the S&P, and on the NASDAQ on 727, you can see this pink bar right here. We could not make a higher high. So that told you that there was a little bit of what we would call a negative divergence on the NASDAQ. And when you get it on the NASDAQ, that's probably a stronger signal for the types of stocks we look at, because most of them are in the NASDAQ, and that's the growthier index. So the NASDAQ, it's very subtle. It's only a single instance. You wouldn't run for the hills on a day like that, but it's like a shot across the bow. It's your first alarm bell that maybe something isn't quite right with this market. So then when you get this distribution here, you get a little bit more distribution, you're able to react to that. You're more aware that maybe I need to start reducing my portfolio. If you're 100% invested, you get a day like that, maybe you go to 90%. Then you get a day like this, you go to 75%. You get a day like this, you go to 50%. You get a day like this, you're down to 30 or 20% in your favorite names. And it helps you to avoid, kind of the washout that this happens. And then the market tries to rally back. You make a high here, and the difference there, 1446 minus 14149. And I apologize, this was off the cuff. I wasn't planning to calculate that, but this is how I think about the markets, and should have had this number kind of on my brain. It's about 2%. So let's go to the S&P. And 4607 to 4541. It's about 1.5%. So you can't close the gap as much on the rally, and then now you're breaking below the moving average. First time, second time, third time's the charm, and in other words, in this case, third time's the charm the other way. First time, second time, third time, and you could start to see it in the stocks. NVIDIA topped before the market did on this rally up right here. So this is 9.1 is the high. And let's just look at a sign. We'll pull up NVIDIA later. On 9.1 is this day right here, and kind of led the market down, kicking and screaming. So you're in a correction. IBD has the market in correction. I think they were under pressure for a few days, went to correction yesterday. And so you should, if you're, it depends on the type of investor you are. You should be down to really your core favorite names, 30, 40, 50% invested, depending on the type of investor you are. If you like to go short, or I don't know if like to go short is a great statement. Sometimes the short side, I definitely have a love-hate relationship with the short side, but I do go short, and we'll use the short side to speculate and or to hedge, mostly to speculate. I'm not a big hedging fan, but I will speculate on the short side if I think something's going down. It helps cushion the fall here if you have some longs. So I do have some longs, but my longs are none of them are NASDAQ tech related. I don't own NVIDIA any longer, or VRT. Those were some of my favorites this year. And so, the FOMC meeting, and, regardless of what they said, I'm not even certain what Jerome Powell said. I know what they did. They didn't do anything, but I do know how the market reacted. And that's what's most important. It was a really lousy day. Then you gap down today, and for a while it tried to rally. So you gap down, and then it tried to go up, and then just closed on the low again. So really two very poor closes. Big volume day there, volume distribution there, distribution here, because it's getting higher. And it looks like probably tomorrow we'll test those lows, and maybe they try to catch it or something, try to save it. Tomorrow's a Friday, and you probably wouldn't want it closing like this on a Friday. That wouldn't look all that great, but it looks like, I don't know. I mean, I'm not big on targets and things like that, but it just feels like the market's coming down to this area, which is where the 200-day moving average is. S&P, it's a little bit, more room, but the S&P is actually undercut. Did it close below that 43? Yeah. 43.30 was last, and so close 5 points below it's low. So old school, using the William O'Neill cancel method, the rally is dead. You've undercut that low. We undercut the low of the follow through day, which is kind of new school signal that the market's not all that great. And so it is what it is. It's not a great market. You're as an individual investor, you're lightly invested at best, is probably how most of you are playing it. And then you're watching. Doesn't mean you give up on the market. Doesn't mean you stop doing your work, because this is how stocks build bases, is when the market's correcting. And so you want to have some type of watch list. So when the market gets better, whether it's 6 days, 6 weeks, 6 months from now, there will be a rally. Always has been, always will be. And that's where the big money will be made, in those rallies. Okay, as far as anything else on the overall market related, I think I'm okay. Let's jump to the industry groups. Let's see if they can tell us any type of story. So the number one group is computer hardware peripherals still. And that's because of the big move that, like, SMCI made. So, stock went from, this year it went from 90 to 357. But regardless of that, it's gone from, at this point, it's gone from 90 to 231, which is still a big move. And so that's what's made this group very strong. Dell has done pretty good in this group as well. Actually, better than pretty good. It's holding the gap really well. That's pretty strong action. The second group is oil and gas field services. And so, like Tidewater, to me is the leader in this group. I think Halliburton would probably fall in this group. Yeah, it's big. Schlumberger would fall in this group. But the one I've always gone to is Tidewater. I think that's the best stock because it has room to grow from a size standpoint, whereas like Schlumberger or Halliburton are just so big. From a market cap standpoint, number of shares outstanding, the earnings and sales are better, much stronger. So that would be my go-to stock in this group. Energy coal, very interesting. So CEIX. And I apologize. Let me turn off my camera just in case I'm covering up the charts. So this is broken out of a base. It's up 34% in 34 days or 43 days. AMR up 27% in 29 days. So that's that group. Oil and gas, machinery, equipment, insurance, life. So that's something new that probably wouldn't be my favorite group. So like telling giving me a story that's not very growthy, right? So 6 months ago, you can see insurance life was rated 105. 3 months ago, it was 43. Last week, it was 7. It's currently 6. It's moving up the food chain. Not my favorite group moving up the food chain. I would rather have semiconductors, software, stuff like that. Those are more growthy as far as if you're looking at the NASDAQ. So you can see that if I scroll down here, steel, medical, computer data storage, that might be a bit growthy. Oil and gas again. Beverages, non-alcoholic, that's done well with like Celsius. We can pull that up later. Internet content. So that would be a growthy group that would interest me. So I'd like to see more of those types of groups moving up the food chain. You can see these ones are actually going the wrong way. So internet content 3 months ago was the number 3 group. Last week was 37, currently 25, and so on and so forth. So this is an exercise you probably should do once a week. I don't think it's worth the effort to do every day because they're just not that dynamic, the groups. But once a week on the weekends, go through this, look for that delta, see if you see any groups that are changing significantly for the better or for the worse. Maybe you own a bunch of stocks in a group and the group is getting poorer. And if you see something that you haven't done any work on, like let's say steel specialty alloys, I've never looked at that group. Well, you click on the name, and then you open up the related information panel over here. You've got the overview button, which gives you the details of the group. You've got the stocks in group. So I can see ATI, Carpenter. These are all the stocks in the group by market cap. And then if I wanted to review this group, I can click this button down here called Show All Component Data. And there's Carpenter, there's Universal Stainless. So Carpenter is on top in this list panel, whereas ATI is on top in this side panel. The side panel is sorted by market cap. You can see ATI is the largest. But down here, we like to sort them based on our indicators, more relevant. And there's only 9 stocks, but imagine there was 39. Then a sort would definitely help. And what we're doing is we're taking the EPS rating and the relative strength rating, adding those two together, and then sorting based on the raw number. 98.81, 179 is larger than 95 and 72, which is larger than 93 and 39, and so on and so forth. So I probably look at, say, 10 to 20% of the names. So if there were 20 stocks, I'd probably look at 5. If there were 30 stocks, I might look at 7 to 8. It just depends. Like as I spacebar through this list, so right away, like Carpenter is the one. Like look at that. Look at the earnings and sales and the relative strength, and stock's barely off the highs, is beating its chest in this correction. So it's telling me that's the leader. I don't really know if I need to do any more work. if I want exposure in this group, I got to find a way to buy Carpenter. But I'm for the sake of this drill, I'll click Universal Stainless, and that stock is not nearly as strong as CRS. So then ATI broke down a little bit today. Constellium, that looks okay, but look at the last couple of quarters of earnings and sales. Not all that exciting. Probably a pass for me. TMST, huge base, but again, look at the last quarter earnings and sales. So it's real simple. It's Carpenter or bust, and add that to a watch list. Put an alert on there or something. Maybe I want to buy it on a potential pullback. Hopefully you get that moving average and they meet like that. So I might set an alert. Let's right click, set an alert at 62.50. I don't think it's going to get there, to be honest with you, but who knows? Fast forward a week or 2 or 3 from now, if the market's really bad, you could push this stock. It could pull it kicking and screaming lower and give me a chance at that moving average. So then now it's let's go back to those industry groups. And I just looked at Steve, and then rinse and repeat, move my way down. There are 197 of them. I wouldn't do what I just did for all 197. I'd probably stop around 40 or 50. The nice thing is, let's say next week, steel special alloys is moved up the food chain. I don't need to do any more work. I already know CRS is the one. That's the one I want. I've got my alert set there. So I can, when I see that name, I can just pass. Okay. Let's jump to stocks to watch. I guess I always start with NVIDIA, and it's getting close. So it did today, broke through this kind of descending trend line that I drew, closed on the low, the volume is up. I actually am hopeful that tomorrow you get through this low at 403. I'm going to draw an alert there. And maybe I get some kind of shakeout potential buy that I would take. If NVIDIA went down to 390 and then closed at like 398 or something, I might be interested in taking a shot on something like that. It just depends on, again, what type of trader you are. But the stock is under a bit of distribution, and it's been one of the, if not the leader in the market as far as size. It definitely has. So it's an important barometer of the market, and so far not acting well at all. It just couldn't rally at all today. I think it was, in fact, you barely see there's a gap between those two prices. So the stock was never even up a penny today. ELF, which is definitely or was a leader. So look, you do get, this is what I'm talking about, that type of thing for NVIDIA. So ELF got a little bit of support today. It was down 2, 4, 6, 8, 10, 12, about 12 of 13 days in a row. So just really got hit pretty hard. You have a nice volume bar. It's just one day. I wouldn't be in any hurry, but interesting to see that they supported that stock today. But here's your clue: when the market starts to roll over, when they start to get the leading stocks, then it's really hard for the market to hold up. The good news, if there is any, is that almost always when they get the leading stocks, and when I say get them, I mean finally make them the price action breaks. It's usually near the end of that wave down versus the beginning. They sell their best merchandise last. So if you're a portfolio manager at Fidelity or whatever, you just don't want to get rid of ELF. It's been good to you, but maybe you're feeling the heat from the other names that are going down. Maybe you have some redemptions, and so you might have to trim something. So this is foretold this sell-off, and you can see how it's respected this moving average pretty much perfectly the whole way up. And depending on what it does Friday, it's unlikely it's going to be up 20 points tomorrow. You've got a break of the 10-week line on big volume, and that's a defensive sell signal. So if you bought ELF here, and you're using a defensive sell signal, you've basically gotten it this week. So it needs a whole new base. Let's go to cell H, Celsius. So yesterday was only down a little bit, and I thought, it looks like it's going to roll over because ELF and NVIDIA and everything is just rolling over. And it's just holding up. And a lot like that, they just got it. They just couldn't stand the heat anymore. It's down 16 points. So it's at about 8% yesterday. Gave back another 6% today. You're right on the moving average. Should be interesting what happens tomorrow. But this is another leader that you want to watch to give you a barometer for the market, and it's not a good sign. Very few big liquid leaders that are saying that the market's okay. Lilly. So, I talked about this kind of upper trend line that the stock was getting a little extended on, and like that, and it turned out to be, prescient. I think I was thinking maybe here or here. So you're never going to get the high when you sell into strength. That's the hard part about taking profits is almost always the stock will keep going up. But so if you sold at 575 or 585 at 600, you're just kicking yourself. But now at 550, you look like a genius. So you're never going to sell the high. So you just when the going is good, maybe if you want to keep some of it, but do some selling, trim some, whether it's 20% or 80%. Yeah, it's all up to you. For me, it's more of an 80%. I just find that there's an old Wall Street adage, profits are like eels, they're slippery. And that's my experience. Now we all have the ones that got away, the Apples, the Googles, the Nvidias, the Amazons, but those are few and far between. So I think most of the time, maybe not all the time, maybe half of the stocks or maybe 3/4 of them, depending on, again, your personality, type of trader you are, maybe only a quarter of them, you keep the rest, but you really want to take some profits to pay for some of the losers, to help you, overcome the volatility that the market can exhibit. Because at 600, you might say, I'll never sell it. And then at 500, you might say, oh, I can't stand the pain anymore, and sell it. So you're always better off, taking 580 or something like that. So Lilly and NVO, the two big leaders in the drug area, 2-for-1 split for NVO. Not broken, but they look tired. Let's look at Apple. So Apple doesn't look all that great. You break below the moving average, you try to rally, you get another bad break. It is Apple. It's one of the great companies, but this is not all that exciting. So here's your earnings and sales, very pedestrian. And so it looks like the stock's under distribution. For full disclosure, I am short Apple by being long the Apple reverse ETF. And there's not that many of them, but I wish there were more. So there are some of these reverse ETFs that can help train your eye to spot when maybe stocks need to be sold. So like Amazon, there's an Amazon down. There's an NVIDIA double long up. There's an NVIDIA down one too, which has just gotten torched, of course. And there's a Tesla long one, which I was long here and here. And so like I look at that, pretend you don't see what this is, and you come across this chart. Let me backdate it to last year. Let's just find, like, I don't know, how about that? Does that look bearish? Would you want to be short that stock? This right here? No. So it looks like a buy, and that therefore maybe looks like it's coming out of a big base. And so therefore maybe Tesla is a sell if you're long it, or an avoid if you don't have it, or if you're interested in speculating a short. And it worked really well. Went up went up a lot, enough to make some good money. It went from 40 to more than doubled. So yeah, I am in the AAPD, and it's a little early, but it looks like potential bottom. We'll see. And then Tesla. So Tesla is interesting. It's really holding up really, really well. It's a cup currently, and I think 1, 2, 3, 4, 5. After today, this is going to become a cup with handle. So the nice thing is you got a pretty well-defined buy point for Tesla if it were to break above this handle high, which is about 278. You see, I've got a descending trend line drawn here. So if stock were to break that trend line to the upside, depending on the market environment, that would be a buy signal for me. So I like the descending one, because the stock just does this for a number of days. This is going to keep going down, and then maybe I can get a little bit of a sooner entry. But it's holding up okay. Tesla. I mean, I know it's not nearly as bearish as a lot of the other names that I just mentioned. Today you had Splunk got bought out, but like CrowdStrike had really good like an investor day, I guess, last night, and the stock tried to open higher. Let's go to like a 15-minute. This is good barometer for the market. So stock opened around 168. I actually bought it. I didn't have that much long exposure, and I was short some names. So I bought CrowdStrike because I really like this name. I love the earnings and sales and the group. I mean, cybersecurity is not going away. So I'm always willing to take a chance on something like this. And, I'll be honest with you, pet stock, it was one of my better stocks in the 2020 bull market. So, you tend to have an affinity for them for sure. But if I go back to the intraday, you can see it just wiped it all out. This is a lousy day, and I got stopped out on it. So kind of a barometer for the market. CrowdStrike probably should have gone higher and couldn't. The guidance is very strong, and just that tells you something about the market. So it's kind of it's a good signal, meaning a reliable signal, but not a good signal. It kept me from doing anything else on the long side, because it shouldn't have gone down. It should not have been negative. Maybe it doesn't have to be up 10 or anything like that, but probably should have held up $1 or something like that at least. I think at the high it was up maybe 3 or 4. So didn't like the action there. Where I am positioned is in stocks like LPG, which is oil and gas transport pipeline, building this cup with handle. I always, well, I don't say always, because I will buy stocks with no earnings and sales, but if I own 10 of them, 8 of them are going to have big earnings and sales. So this looks interesting to me. Frontline, last quarter earnings up 327%. This looks like a big cup with handle to me. The pattern rec the company pays a big dividend. So we've adjusted the chart due to the dividend. So that's why it doesn't see this cup with handle, but that looks like a cup with handle. I do own that one. And so that's where my minimal exposure on the long side is. Okay, I think that's all the stocks that I wanted to talk about. So let's go ahead and jump to the quote of the week. Peter Brown, he is the CEO of Renaissance Technologies. Renaissance is a famous quant fund. They have incredible performance. Very secretive. They normally don't come out and talk, which is why I was very interested in this. It was on a podcast. James Simons is the, kind of the main guy, the founder of Renaissance. And he said, this is what he said: our fourth principle is no interference. We don't impose our own judgment on how the markets behave. There's a danger that comes along with success. You start to think right? And you get yourself in trouble. I've done that before. To avoid this, we try to remember that we know how to build large mathematical models, and that's all we know. We don't know any economics. We don't have any insights in the markets. So the guys with 35% plus compounded returns for 35 years, they don't know where the markets are going. They're not gonna. You don't have to guess where the market is going. You just have to kind of go with what the market is doing. We just don't interfere with our trading systems. So if you don't have a system, you need one. It doesn't have to be like them. They have I don't know if it's not discretionary, their system, but you should have some kind of system. Like I buy X percentage of my account per idea, or for me, it's 10%. So I always buy 10% of any idea from my account, unless I'm trading poorly. Then I reduce that to 5%. So it's either 5 or 10. It makes it easy. That's my system. And I can add to that name if it works, but I'll always start with those numbers. I stop myself out with a max loss of 5%. So that's your system. You don't interfere with that. Sometimes you might get an outsized loss because the stock gapped down. But if you have the chance to take your loss based on your signal, you take it. You honor your system. So that's the best way. And I think what I like about this also is, they know what they don't know, right? I think that's a Larry Haight quote. He said in Market Wizards, we know what we don't know. So there's some value in knowing what you don't know. If you think you know and you're wrong, you can get run over and get yourself in trouble. Okay, everyone. So thank you. If you have any questions, you can contact us, marketsmith@investors.com, 800-424-9033. Have a great weekend, everybody. We will see you next week.